So what's happening here is we already know what we've talked about. The Fed is planning on tapering off its big asset purchasing plans, which is basically like, hey, we'll buy assets from you, we'll give you liquidity. For with the cash in the market, you can do your everyday business and cover all your obligations, and it will cost you. We'll buy up debts and we'll buy up assets that you may be holding. So we kind of trade it there. The Fed has bought effectively $982 billion of the mortgage bonds since March 5th, 2020, when they started buying to help provide liquidity to that market to keep housing from going under, right? To keep all the rates really low, because as they continue to buy $40 billion each month after that, they continue to buy. What's happening is you're keeping the cost of borrowing much lower, so you're keeping people from having these high mortgage rates because you're buying up all the debt. So the risk is much lower because the government will literally buy the debt out of the market, and the the thing about this is that it does help push down these rates, and some of the Fed officials have come out and said this has some unintended consequences. Because if you look at a peak of demand, you look at a contraction of supply, then you also say, well, then mortgage rates are so low because they're buying up all the debt. You add to the fuel of this, this kind of housing boom fire where the prices are up 24 to 30% across the board for most new houses, and people are getting outbid every time they try to buy a house. So it's really that the Fed stopped backstopping this market already, because right? The mortgage home market, the housing market doesn't need help. Like it's actually growing and booting in value. It doesn't need just fine on its own. It does not need you the extra help of keeping these rates lower. And other Fed officials on the other side, right? They're arguing that the combined purchase of mortgage and Treasury securities are keeping the entirety of long-term borrowing rates down overall, which is true, right? Which is why they did this across the board, because you find the place where you're going to have the biggest rates, you find the place where you're going to have the most demand, and you buy all that debt. So therefore, you keep the rates low and you keep liquidity in those high demand markets. The only problem is, we're seeing a different reality now. We're no longer in the middle of COVID. We're in the aftermath where these markets are burning up really, really hot. So it doesn't really justify the need to do this. So they're suggesting a two-speed taper where they taper off mortgage buying first, and then they taper off the treasuries as well. So they don't do everything at once. They try to do it one and then the other. The only issue with this is that it does create a bit of the reason they might not want to do this is because it does create complexity in when they try to push this out into the market and people know what is being sold and when, and that's where we get these taper tantrums, right? We don't want to make it too complicated because financial markets might not know how to deal with that. They may react erroneously. So that's the debate. Should we start doing that early, or is two speed too complicated to implement it at this time? So, but the whole thing is that we're having artificial rate hold downs as a result of this. But do we really need it? And is it really helping the housing market that is exploding in value with some of the lowest mortgage rates we've seen in quite a long time? So I would say that they definitely should stop doing this. I think they should stop doing all of it. But the most effective way to do this, the most effective way to raise mortgage rates and cool that market, is to raise those rates. And to do that, you have to just raise interest rates, period. So the Fed said they're not going to do that until 2023. So even if they do stop buying back mortgage bonds, it might not have as big of an impact as raising interest rates would in general. So I think that, and I, again, proponent that I think they should move a little bit faster in this respect. But I definitely think this is a good idea because the mortgage market and the housing market is burning pretty hot. So I don't think it needs any more help. I don't think it
Yeah, good insight. Yeah. We're going to continue seeing more and more of how this is going to affect the potential housing crisis. And I mean, do you predict this accelerating it or potentially even fixing it?
I think this is just part of why it is so red hot. I think the biggest drivers are demand and a lack of supply. And demand being the biggest one to push the prices. Because remember, even if there's a lack of supply, if there's not so much demand, then the prices don't go up. It really has a balance here. But we're seeing a lot of demand that is fulfilled both by supply or the ability to buy things. And I think that demand is the hardest part of this to manage. And if you're trying to manage demand, you have to find mortgage rates, because if it's more expensive to get a mortgage, you're less likely to buy a house. So it would cool the demand of people trying to get homes. But to do that, the most effective way is to do it straightforward, to raise interest rates. So I think that's all kind of baked in, and I think that's what they're kind of noticing, because they've been doing this since March, and these prices have been elevated now for months. So I think it's already kind of baked into it, but I think the longer it goes on, the worse it's going to get, just in terms of keeping that market, so expensive for much longer. So
Sounds good.